Fusion, the International Science Radio Show.
My name is Marta, and I am a lecturer at the University of Adelaide Business School. My research is in market microstructure, which has to do with trading in financial markets and studying intraday data from that process, primarily to examine how regulations impact markets. And I teach a course called Business Analytics Project, which is a postgrad, or it's not postgrad, it's like a master's course, which helps students master the data skills they need for a variety of things, including business analytics, data analytics in the business context.
Should I start with going a little bit into your research and then into the comedy, or would you rather start with the comedy and then go into a little bit of your work?
Right. Well, the comedy was a chance to look at my research in very down-to-earth terms without trying to make it anything more serious than what it is, which is just using data to study things in financial markets. And I think data is useful in many contexts. I think it's probably socially useful in kind of the discourse that we are having in everything in life, because looking at numbers doesn't paint a picture that is tainted by opinion. It paints a picture of reality as it is. And I think that's what I really appreciate about using data. And in the context of financial markets, it just, in the context of my research, using data is helpful to see whether a particular regulation, for example, in the stock trading is helpful to make trading easier for investors. Elsewhere, they apply also these tools in other contexts, like maximizing the portfolio returns or optimizing a trading strategy. But in the context of the research I do, it's mostly to see what's useful overall as a practice in trading. And it can be useful from the perspective of like ease of trading, which is liquidity, or whether what people do in markets has, optimal consequences for those people themselves or markets overall. Like, for example, in the case of the Gamestop story that I talked a little bit about in my talk. So yeah, I think like to me, comedy is like another tool of storytelling that strips the complexity of the topic and also gives me a chance to play a little bit with the different concepts and how to understand them. I think I only touched the very basics of the very crust of comedy. I can't say I really delved that deep into it, but I like to think that comedy is, it could be like almost a tool of psychoanalysis, if you like. If some people are paying you instead of you paying the people.
Do you think you might make your lectures a little bit more funny?
I already do some of that. I have a couple of sessions on, one of the things that I do is I look at helpful ways to visualize the data. And there's a lot of funny things in there, like, all kinds of stories that you could tell with a graph that are not truly true. So I remember one of the sessions I had probably after my comedy show had this graph of COVID deaths, which is not a funny topic at all, but it had this clear seasonality, and it appeared on the graph as if everyone was waiting until Mondays to die. So no one was dying on Sundays, or very few people were, and like everyone was just dying on Mondays. And I remember just kind of asking my students, what do you think is happening here? Why is everyone dying on Mondays? And if it's truly Monday is the day to die. What are we doing here? Our session is on Monday. Something along those kinds of lines. But I can see a lot of potential in incorporating funny bits into the course I teach here in Adelaide. It's definitely the kind of visualizations is one ripe topic, but others and people do comedy about those things. I know my partner was showing me some comedy on that. It's not like I came up with the content with the idea of that originally. But I have the topic on lying with the data, and there's a lot of right material there. Like kind of you can put numbers together or graphs together using data in such a way that just stirs all kinds of conspiracy theories. It's just really funny how you can tell that narrative, like supposedly with the numbers, but truly understanding what the numbers really mean is a bit of a deeper thing than just coming up with the most outrageous story that I can paint.
Was it
so it's in some ways already in there. Yeah.
So we've teased the audience a little bit here. Was the just for them to think about, were the COVID results skewed by when they were counting the deaths, when the statistics were collected, or?
Yeah. So the seasonality of that particular graph, which was the number of COVID deaths in Florida, the way that the graph was pulled together was affected by the seasonality of both reporting, I think, and the way that hospital system works. So it's possible that on that occasion with COVID deaths in Florida, that reporting of those deaths had a delay. So over the weekend, there would be no reporting or very limited reporting. And then that data would enter the system on a Monday, and it would be recorded on a Monday for both Monday, Sunday, and Saturday. And then you just had a spike on Monday. Yeah.
Right. And so this same sort of data analysis for medicine is the same science that you use to analyze the markets.
Well, similar. The tools are slightly different, but it's the same statistical concepts that we both use. So in all those research trials that happened for COVID, at the core, it's the randomized control trial design, where you assign people to a treatment and a control group. That is and especially when it's double-blinded, so both the participants and the researchers do not know whether the particular person is in the treatment or control condition. So given a real vaccine or the placebo. So the same tool, like that's an example of a tool that is used both in medicine and in what we call randomized control trials in, say, international development, or by the Securities and Exchange Commission, SEC, in the US, when they assign securities to different groups. And one example of that was the tick size pilot that they ran in 2016, where they tried to study whether increasing the tick size, just the lower limit of the bid-ask spread, whether that helps increase liquidity in the stock market. So yeah, similar randomization principle, but just different underlying process than in medical research. Yeah.
And could you quickly define what liquidity is for the audience that haven't heard of that before?
Yeah, well, liquidity is how fast is. Perfect liquidity means I can trade a large amount of stock without paying too much for doing so to the dealer or through executing through the stock exchange limit order book. Large in size, cheap, and immediate. So I don't have to do so over an extended period of time, but I can execute that right away. But ease of trading is the simplest way to define it.
And you mentioned the saga of the Gamestop stock, which, as I recall, was between people organising on Reddit and the big investors on Wall Street over a game company stock.
Right. Well, it's funny that I do. It's just kind of another manifestation of things that happened at the time, right? And one of the things that was happening was COVID and people being bored at home. And as people are bored at home, they look for ways to entertain themselves. And one way was to, sit on Reddit and post things and see what others are doing with their stock trading. So they had more time on their hands, and I do not think they necessarily it's not like someone was originally plotting or how do we punish the hedge funds, but like one of the sentiments obviously in general in society, but also especially in this group of people who trade stocks and at the same time sit on Reddit and exchange opinions about things, stock trading and otherwise. There's this mentality of let's go socialism and why are the richer getting richer, the rich getting richer, and so on. So it's not unpopular sentiment in general, but it's, I think, especially popular in that group of people. And I think eventually it did become a bit of this tug of war. I don't know if tug of war is the right term, but obviously when the stock doesn't have promise, a rational thing to do is to short the stock, which is to bet against that stock. So in other words, try to profit from the fact that eventually the stock price is going to go down. And that's what large institutional investors and hedge funds do. And so they did that same thing as they would do with any other stock, but short positions are reported, they are in public domain, so one can actually see that the short interest in that stock was piling up, and really they could tell that a lot of institutions are shorting that stock, and I guess that gives kind of an extra piece of data for Reddit investors to say, hey, we're gonna burn you on this one, because obviously the more the stock increases in price, the more incorrect your institutional investors are about their bet against the stock. And so obviously the more money they lose. And now your socialist argument about let's not let the rich get richer, that suddenly becomes like a very tangible punishing tool to observe how this big guy.
Oh, you froze a bit there, so I think we missed the end of what you said after the big guys.
Right. Okay. Let me
I'm
make
getting a
sure
couple
my
of
internet.
freezes, but it's the first time it's cut you off. Oh no, I can't see you at all.
Okay, sorry about this.
That's okay.
I guess I got disconnected with the internet, but
You did.
I think it's back.
It
I
seems
am in
to
the
be.
office, by the way. I'll blame it
Right.
on the university internet.
It should be really good at the university.
Yeah, I know.
Odd. So we were talking about GameStop and how basically the people on Reddit used their vast numbers to buy a small amount so they could afford of the GameStop stock, so that the prices would go up and the hedge funds would lose their short bets that the price was going to go down.
Okay. Can see.
Did you hear that? Or because you froze again at the
No,
end? Oh no!
froze again. Yeah.
Oh no!
I'll just switch to mobile internet so
Right.
it doesn't get interrupted. Yeah. It
Okay.
shouldn't happen anymore.
So you didn't hear what I said.
No,
So
sorry.
basically, I'm just saying that you and I were talking about the GameStop stocks, where
Mhm.
the Reddit, there many people on Reddit all bought little bits of the GameStop stock, so that
Yeah,
the
yeah. It's a
price would go
mouthful.
up, and the hedge funds would lose their short bets that the price was
Yeah,
going to go down.
that's right. Yeah.
And some of them were trying to refuse to sell ever. They were just going to keep hold of it and try and keep the price up.
Yeah, well, there's lots of things going on here, right? There's this whole idea of, like truly believing in the cause, or in this case, just in the stock. There's no financial reason to believe in that, but eventually, like GameStop actually did well in terms making use of that increase in the stock price, because like as a company, if you're experiencing that kind of influx of investors and buying your stock and pumping up the price, what you can do is
Yes.
you can issue new shares, and so you can kind of raise money at a better valuation. And I think I can fact check that, but I think they did do that, and they did use that money in doing some useful things and kind of in the real business sense. So it's not entirely useless that your stock price goes up. It can affect your actual business operations. But ultimately, like GameStop is not, something, it's not a high-end chips manufacturer or something that's really going to make it big because of how hot the area is, or how profitable they are right now and in the future, based on
Yes.
expectations. Yeah.
Let me think. So, when you talk about the microstructure of a market, what does that mean?
Yeah. Well, it means several things. It means the machinery, so things like trading systems and matching engines of the stock exchange, and the stock exchanges that exist, because usually it's a fragmented market. So it means all the infrastructure, let's say, that allows people to trade. It also means the outcomes of that and how we measure them. So things like how we measure this ease of trading, which I call liquidity, and how we measure what we call price discovery, which means how easy it is to incorporate information into prices. So how informative prices are from the perspective of saying something useful about the company's future cash flows. So again, by trading on information, I incorporate that information into prices. I buy a stock that I expect to have better future cash flows. I sell the stock that I expect to perform less well. So by doing that, I help the market perform its function, which is price discovery. And so these elements, the infrastructure of the market, so the actual systems involved, the ease of trading or liquidity, and this function of price discovery, those are kind of the three key elements, I would say, of what the field of market structure is about. And I call it market microstructure. That's more academic term. In industry circles, it's called market structure, and it's about those three things, more or less. Yeah.
And how did you find the comedy trading to go on the other path?
Comedy trading, did you
Sorry,
say?
there's a whole other thing. I was thinking about the comedy school workshops that you would have done,
Right.
but it's a good question.
Well, the comedy school workshops were wonderful. It was a perfect mix of practical tips for how to perform well in the public speaking sphere and how to make it funny. So I'm really grateful to David and Seaton from Future Science Talks for training us up. So all up, we had 4 or 5 workshops, if I remember well, and it started from the general exposition of what comedy is and tips on how to write our script, which was about the first session. And I recall writing that script and rewriting it probably 2 times to kind of based on their feedback and based on how my understanding evolved of how to make things succinct enough and funny enough, and also at the same time have a story to it. So I think there's different ways to do comedy, but in this particular case, I did want to have like the actual storyline to follow. And kind of fleshing that out was part of the exercise as well. And I think I emerged with a much better understanding of like what's funny and why it's funny, and also understanding better, like if I ever were to dive into that world, how that differs from where I am, like where would I have to bridge the gaps. I saw a few more comedy shows, part of Adelaide Fringe, that showed me kind of the new world. I didn't know that much about that world, even though I did do some improv back in Sydney, so improvisation, which is quite different, but that does overlap. And so really great overall.
So you could be explaining the markets. And when we talk about the markets, are we mainly just talking the stock market, or you talk about other markets as well with your work?
Yeah, well, in my work, it's mostly just the stock market. That's what my research is really about. But when you think about markets more broadly, so starting from like used car market, for example, is one idea, and one thing that is often brought into context of studying market structure. Like fundamentally what happens in markets is there's this information asymmetry between buyers and sellers. And so if I go to a used car market and I'm a buyer and you're a seller, I immediately suspect that your car has something wrong with it. And that's what we call the lemons problem. And that lemons problem is part of any market. And understanding how, like fundamentally to make the market function, you have to solve that lemons problem. So if I always distrust you, I always believe that your car is faulty, and that's the only possible reason that you're ever going to be selling it, I'm never going to buy that car. And so there's no transaction. So there should be, one way to solve the lemons problem is that, there are different reasons people sell their cars, right? And with some probability I can get like a decent car. There's also this, so that's what we call kind of the way you solve that problem in the stock market, right? You have noise traders in the market. So you do not only have informed traders who sell their stock or their car because they believe it's bad, but there are people who just need to go to, I like to have this example, like they need to go to a dentist, and because it's so expensive to go to a dentist, you have to sell some stock just to raise the money. But so there's this fundamental dilemma in the core of any market, and it's going to be the same dilemma in the the Adelaide market for fruit. Yeah, like I go to the market and like I shop around, and it's a bit different because there's actual like information plays less important role in the buying of fruit. I can kind of inspect it, and the fruit is a fruit. Yeah, but like with used cars or stocks, so there's a lot of informational content involved in the thing that you're buying and selling, so that that stock has some unknowable future cash flows, that car has some unknowable future problems, and so on. To the extent that there's uncertainty about the thing that you're transacting on, the same principles that I apply to the stock market, I can apply to anything else. And fundamentally, it's about how to make a market work, how to make sure that people actually do meet in the middle and transact, and that they do so in large enough volume that justifies other people coming in and finding that liquidity or ease of trading, is full enough, easy enough that that they can actually benefit from coming to that market.
One of the things I've seen in financial news a lot that I really hadn't even heard much about, exchange traded funds. People are getting very excited. Would you be able to explain briefly what they are and why people think they're such a good thing for whatever it is that they're trading, whether it's a crypto or a metal or whatever it is?
Yeah, so exchange traded funds or ETFs, they're traded just like ordinary shares, but underneath them is not a single company, as is the case with ordinary shares, but underneath them is like a portfolio of companies very often, if that's an equity exchange traded fund, or a portfolio of bonds, if it's a bond exchange traded fund, or just even a single thing like Bitcoin. So Bitcoin is just a single thing that's underneath that wrapper of exchange traded fund. So why would you want, for example, why would you not go and buy Bitcoin directly? Well, in case of Bitcoin, which is the hot topic with exchange traded funds, because just recently got finally approved in the States and arguably fueled the huge price spike in Bitcoin, which which hit it's another highs now. So why would you want, for example, to hold a Bitcoin ETF as opposed to hold Bitcoin directly? Well, one reason is maybe you want to interact with the traditional financial system of U.S. Regulated by the U.S. Securities and Exchange Commission, and all the rules of that system are subject to securities law in the U.S. It's predictable. You trust that system. Suppose you trust it more than you trust another Bitcoin exchange that could be hacked, or you would rather interact with that system than the financial system that emerged to cater for Bitcoin and other crypto investors, which itself is also trying to get the regulations up to speed and get integrated, but that takes time, and who knows if it's going to happen, and there's been lots of pitfalls down the road. So now you have I think it's BlackRock, right, one of the top ETF issuers in the US, buying the Bitcoin for you from this other system, right, and then holding it in custody. So put it that way, like kind of having a system that allows them to actually just hold on to that Bitcoin on your behalf. And as they have that in custody, they issue an exchange traded fund, so a piece of paper against that actual Bitcoin that they hold for you. So it's 100% backed by that direct Bitcoin that they hold. And they are just allowing you to trade a piece of paper that says, I own Bitcoin, right? So that's kind of an ETF example with Bitcoin. In case of like traditional equity ETFs that I study in one of my papers, I can, instead of, if you're kind of a very boring investor like I am, and you don't believe that you can make money by stock picking, because maybe you don't have time to, investigate what is the next hot thing. and keep track of it over a long period of time. Perhaps what you believe is just you want to hold the market overall, and that is usually what I recommend when my friends ask me what they should do with equity investing or stock market investing, and say, well, buy some ETFs that are as broadly diversified as possible. And ETFs, in that traditional case of broadly diversified index investing, they just hold, for example, to 200 largest Australian companies, right? That would be, for example, the ASX 200 ETF, right? So they hold those companies in proportion to some index, could be ASX 200, S&P 200 index that follows the ASX 200 companies in proportion to their market capitalizations. So then you have your diversified portfolio. Even better idea, hold like a world ETF, right? That's because we don't want any home bias. If you truly want to diversify, then there's a world ETF and just holds, I don't know, like it depends on the ETF, but largest, let's say, 1,000 companies in proportion to their market caps from the US, from Australia and Europe and elsewhere. And so what that does is that it allows me to diversify cheaply without actually buying those 1,000 stocks by myself. On top of that, it allows me to save on what we call management fees. So if I were to go and invest in a fund, like asset management fund of some kind, that, let's say it's even a passive fund, right? The passive fund doesn't try to beat the market, just follows the index. It's usually more, it depends, but it depends. It could be a similar fee or higher fee than the exchange traded fund. But with the fund investment, I cannot get rid of my fund units, or in other words, like sell my fund units and get my money back immediately. In some cases, I have to wait until the end of the day, sometimes end of the quarter, sometimes even more time. With exchange traded fund, any time that the market is open, which is usually 5 days a week, during the trading hours, I can liquidate my ETF shares anytime I want, and so it trades continuously, right? So there are two paths to my advice when I say, like, don't if you don't know what you're doing, it's better to buy some ETFs. Like, one reason to buy ETFs, like most of them are passive. So I say, passive ETFs, just the ones that follow the index. If you don't believe you can beat the market. But second of all, ETFs are continuously traded, so it's easy to get your money if you need money urgently. And finally, there's the case to be made about how low the management expense ratios are. So basically, there's the simple way to just minimize your fees by picking the cheapest available ETF. Because if you're already investing in a passive index, you're not gaining anything by getting the more expensive in terms of management expense ratios ETFs. So just minimize your fees. So there's as low as 4 basis points or 3 basis points, which is 0.0003 of the return that they deduct. So yeah, that compounds. If you're a long-term investor, you'd rather have like the lowest possible fee, because that reduces your return no matter what. Yeah.
And you can get paid dividends through an ETF?
You can. So it depends on the ETF you choose. Some of them have dividends and some don't. So you can kind of read what they have. But yeah, some of them have the dividend paying shares and they distribute dividends.
Do you have any final comments or things you'd like to mention that I haven't asked you? Because we're running out of time on my
Right.
Zoom session.
Yeah. Well, I'm not sure what the audience would benefit most from, but I think if you kind of come away with like one piece of reasonable advice from like a finance academic point of view. Yeah, I can say like markets are fun, and there are two ways you can engage with them. One way is to gamble, as lots of the Reddit crowd does. And that's a very human thing to do. I would say a prudent way to engage with that is to have kind of only a small amount, a small percentage of your portfolio in some kind of gambling area, and the rest in passive funds, right? So that you don't gamble all your savings away, or your pension away, or depending what you do. If you're a passive investor, like minimize your fees because they are the sure thing, like tax that gets deducted from performance. Yeah.
Well, Marta, thank you very much.
Yeah, thanks so much, Jan.
Study science, because you will find in the study of science a richer, more rewarding life.